Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 293 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Matt is out this week, so Nick Whitaker, our Director of Research and Trading, is filling in for him yet again. So thank you for taking time to record this week, Nick.
Yeah, of course, always.
And before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast for a while now and want to take the next step in your financial journey, I'd encourage you to head to our website, jessupwealthmanagement.com, where Matt offers a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at jessupwealthmanagement.com, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y Charts and as of the market close on March 26th. S&P 500 index is down 4.1% in March and down 2.9% for the year. The Dow Jones Industrial Average down 3.2% for the month and down 0.2% for the year. The NASDAQ Composite Index down 5% for the month and down 7.3% for the year. The Russell 2000 Small Cap Index down 4.2% for the month and down 7% for the year. And the Vanguard All World ex-United States ETF is up 1.7% during March and up 7.4% for the year. 3-month Treasury rate at 4.33%, the 2-year Treasury rate at 3.98%, and the 10-year Treasury rate at 4.35%. So markets rallied earlier in the week, Nick, after news came out last weekend, actually, that the Trump administration adjusted their stance on tariffs. The planned reciprocal tariffs that were initially set to take effect on April 2nd, as he announced during his State of the Union address, will be more targeted than initially proposed, with certain industry-specific tariffs potentially omitted or left out. So additionally, some sector-specific tariffs may be excluded from the April 2nd implementation. However, just yesterday, the administration announced that there will be tariffs on all vehicle imports. So it just goes to show you, I think me and you were talking about a couple of weeks ago, that this stuff just continues to evolve and change every single day. So
it sure does.
And I'm still, in this camp that as much as the administration says, the economy or the market might need to go through a rehabbing phase, so to speak. I still think this administration cares very much about the economy and the stock market, and I think the stock market is the scoreboard for them. Not saying that stocks can't struggle for a period of time, but I don't think they're going to let it get to the point where it's going to start to taint their legacy, essentially.
Yeah, I agree. I think this administration probably cares about the stock market more than most administrations in the past, 20, 50 years, maybe.
For sure. Moving on to tweets, articles, and research from this week. First thing I had was a post on X from Bespoke Investment Research. This was back on March 8th. Jenna will share this chart on the YouTube video. It'll also be in our show notes. So Bespoke says, when we compared the NASDAQ's action since the release of ChatGPT to its action following major tech releases of the last 5 decades, it's been most correlated with the release of the Netscape web browser. seemingly right on cue with the pattern. We got this pullback we're in now. So what this shows is two charts. So the top panel is the NASDAQ Composite percent change in the 3 years after Netscape and was released and after ChatGPT was released. And the bottom chart is the NASDAQ Composite percent change in the 5 years after Netscape's release and ChatGPT's release. And I just found it interesting, Nick, that it's kind of an eerily similar pattern for these two, technological developments that we've had over the past several decades. So, again, not saying that the pattern has to continue. The NASDAQ's price can definitely diverge from, this pattern or this trend that it's been following on par with the release of Netscape back in '94. But I just thought it was interesting because I think, ChatGPT has been the biggest development really since the late '90s. We've had improvements here and there since then, but just found this something that was quite interesting. And if ChatGPT does influence the NASDAQ to trade similarly to how it traded after the Netscape release, it says that we still have some room to run to the upside on this.
Absolutely. Yeah, I think this is one of my favorite charts I've seen in possibly the past year. I think it does a great job putting the .com era into perspective.
Yeah.
And as you can see in this chart, we're still in the, comparatively, we'd still be in the early phase of that and what you might qualify as the healthy phase of it prior to the .com bubble.
Right.
And you'll see a lot in the headlines comparing ChatGPT and the AI trade to the .com bubble. And I think this helps put it into perspective for listeners. And just a reminder that the .com bubble obviously got ahead of itself. But there was good reason for that. It was basically because companies were outspending their earnings grossly. I mean, just in wild proportion. And essentially the market got ahead of itself because it was expecting just this huge pile of fiber to be filled, and it just wasn't. And there was just kind of a misunderstanding with that. And that's the same argument that's going on with AI right now, and why the trade's taking a bit of a pause is all this money that we're spending on AI. How fruitful is that really going to be to the bottom line? And okay, we've bought up all these companies, but how much is that actually going to translate to earnings growth? And no one knows the answer completely, but just based on the earnings data that we have right now and seeing the types of companies that are spending on this, it's very different than the .com bubble when these small companies would come out and their valuations would soar and they had basically nothing to them. So it's while there are obvious comparisons, I would just urge listeners not to get too worked up from the .com comparisons with the AI trade right now.
Right. And again, to be fair, to take the other side of it, what these two charts don't show is the tech bubble burst in the early 2000s, right? So this is just taking a small snippet of time from when some of these quote unquote revolutionary technologies were released to the public, and they're just showing the performance of tech stocks or the tech index, 3 years after that date and 5 years after that date. Well, if you extend this to 8 or 9 years, then you'll see the tech bubble fall apart, right? So, I think it'll be interesting to see, if we get this kind of blow off top like you see in this bottom panel, Nick, with Netscape. It's like the NASDAQ pretty much went just straight vertical, like straight up without any pullbacks for, it looks like a period of several months. So it's going to be interesting to see how that all plays out once we get there. But like I said earlier, it doesn't mean that the NASDAQ has to continue to follow the same exact pattern it did back in the mid 90s. But so far it has, and just found it interesting. Wanted to share it with people. So
yeah, it's a great chart.
Next thing I had was a good blog post from Ryan Dietrich on March 24th titled Stocks Rarely Peak in February and 5 Other Things to Know Right Now. So I just took out a couple pieces of information from this blog post, but I would encourage you to go read the whole thing. The link will be in our show notes. So Ryan says, so did stocks officially peak for the year on February 19th? We don't think so, and we still expect stocks to come back to new highs at some point during this year. To back this up, only twice over the past 75 years did stocks peak for the year in February. And the chart you're gonna see on your screen right now is a chart that shows the S&P 500 annual highs per month since 1950. And you'll see that most of those highs came in December and January. And only 2 years out of the past 75 have stocks made their all-time high for the year in February. So very low occurrence. Again, that could be different this year, but history does show, new highs in the market tend to happen either at the very end of the year or the very beginning of the year, meaning in the first month.
Yeah, or generalize in the back half of the year.
Right. He goes on to say, we found 6 other corrections off an all-time high that took place in less than 1 calendar month, or about 21 trading days. And this is the situation that we're in right now, if people weren't aware of that. And he says the good news is quick snapbacks are quite common. In fact, the S&P 500 has never been lower 3 and 6 months later, with an average return 6 months later of an extremely impressive 14.7%. So again, if you're watching on YouTube, you're going to see a chart that shows the S&P 500 returns after some of the quickest moves into a correction from an all-time high, which is a 10% sell-off from the peak. And you'll see that this year, it only took 16 trading days to move into that official 10% correctionary period. And again, like Ryan said, 6 months later, 3 and 6 months later, the S&P 500 has never been lower. 12 months later, S&P has been higher 83% of the time with double-digit gains. So is it possible that we saw the high for the year? Yes. Is it likely? I don't think it is, in my opinion, based on this data. And lastly, he says they found 13 official bear markets down 20% from recent highs going back to World War II, with many asking whether this could be number 14. We don't think so, he says, but a nice way to show this is to highlight that most corrections don't become bear markets. We only found 13 of the previous 39 corrections eventually turned into bear markets. Or as we like to say, all bear markets started as a correction, but not all corrections turn into a bear market. So this chart, you will see that 13 of the previous 39 corrections turned into bear markets, meaning stocks fell 20% from a all-time high. So again, most of the time, corrections do not turn into bear markets, but obviously, it's more than possible that this can happen this time around. So I thought this was a pretty strong article from Ryan and his team. They always put out fantastic, content, but, I think if you're, a long-term investor, this is some of the stuff that you should be paying attention to.
Mm-hmm. Absolutely. And that last chart where all bears start with a correction, but not all corrections turn into a bear market, that period that they highlighted in that teal box, it's a pretty diverse range from a historical perspective. It's not like there were 10 in one decade, it's spread out. You've got, the 70s, the 90s, the 80s. I mean, every decade. I don't know if I see the 60s in there. Yeah, 60s. So pretty much every decade is, and there's multiple points. So it's a nice, broad, diverse data set, which is good.
Yeah. And kind of like I talked about with Matt last week, it was another piece from Ryan and from Carson that showing, I believe the data was that, we've never had 3 bear markets within a 5-year period, and we've already had 2. So it would be, unbelievably rare for that to happen, given what you just said. It's not like all of these bear markets are from the same time period in history. They tend to be spread out. So.
And the reason that's important is because the market is obviously can be ruled by macroeconomic movements and what's going on in the world. And, the 70s was different than the 80s and the 90s, like with Netscape and everything, and the .com era and the 2000s. And then you had the great financial crisis. So it's good to see markets behaving similarly across different time periods and different things going on in history. That's why we bring that up.
Yeah, good point. Yep. I'll turn it over to you.
Yeah, I have two quick ones here. The first one is from the BOFA Fund Manager Survey, discussing a rotation out of stocks. It's an ex-post from Delia Capital on 3/19. He says the following: Wall Street just saw its biggest 1-month exodus in 25 years. The latest BOFA Fund Manager Survey revealed a record 40% drop in U.S. equity exposure, with fund managers aggressively rotating into Eurozone stocks instead.
And again, just to clarify, BOFA is Bank of America.
Yeah, sorry.
People. Just if people were curious.
Yeah, thank you. He says this could be a turning point in global capital flows. Is it the beginning of a prolonged U.S. equity downturn or a contrarian buying opportunity before the next bull run? One of the reasons I wanted to point this out is because this chart was released on, the BOFA Fund Manager Survey was released on the 18th. This post was made on the 19th. And you can see the chart here and the net move to U.S. equities going drastically lower and pretty quickly lower, historically even. But it's interesting from a timing perspective is when we've seen the pullback in U.S. stocks, and we saw a rally almost immediately after. Mm-hmm. So do you have anything to say on that before my next piece? My next piece just shows the pricing.
No, I think it's pretty interesting. I mean, you had, we're not quite as low as we were in March of 2023, but what happened, 2023 was a great year for stocks, mm-hmm. right? Same with 2017, September of 2017, you had this move to underweight or people selling U.S. equities in 2017 was a great year. I believe, if my memory serves me, the S&P 500 was up, 19.5%. So, a lot of times this could be used as a contrarian indicator. Back in the early or mid 2000s, you had people significantly overweight, and that was right around the great financial crisis. December of 2024, significantly overweight, and you've seen what's happened, since then up until now, and it's been pretty negative. So, I think that this is actually probably a good thing, I think, over the long term. So we'll have to check back on this here in a few months or at the end of this year.
Mm-hmm. So that takes me into just a quick look into the latest price action. And so this is just a reversion chart. This data comes from YCharts, just internal data that we have at Jessup. And it's just a quick look at the pricing action across the sectors. So you can see year to date is the first little section here, year to date through February 19th. And if you look at the S&P on a chart, I picked these dates based on where we reached the peak, from peak to trough, and then the recovery that we've seen over the past 10 trading sessions. So interestingly, you can see the market was very strong through the 19th. But the reason it's interesting is because it's a bit different than the trade we saw the past year, where you see a bit of strength in kind of the financial services and energy and basic materials, comm services as well at the top there. So not your typical AI trade, right? Mm-hmm. AI took a bit of a pause. So then we have the correction, which starts on February 19th and goes through March 13th. And you can see some of the high flyers over the past couple of years were hit the hardest, namely technology and consumer cyclicals. And you can see that that's a pretty clear textbook defensive rotation, where the sectors that held up the best were healthcare, utilities, real estate, and consumer defensive. Procter and Gamble, Walmart, et cetera. You also hear consumer defensive called consumer staples. So lots of names for those. And relating this back to the BOFA Fund Manager Survey, again, that was released on the 18th, which you have to imagine they're gathering data in that period of the downturn, probably most of the data in that period of the downturn. So what happens on the 13th? We have the buy the dip, essentially, and you can see from the 13th to the 25th where the sectors have kind of shaken out, and you can see defensive sectors falling behind, as we would expect. But it's been a bit more of a return to what we saw strengthen at the beginning of the year, where you see strength in comm services again, financial services, energy. Consumer cyclical did make a bit of a recovery, as did tech. But just interesting to see. It's I think pretty healthy market dynamics, and I don't know if the price action necessarily supports a massive exodus or a massive 40% underweight to U.S. stocks. That I'm not sure that makes sense to me.
Yeah, I would agree. I wouldn't say any of the market action has surprised me. Broken up into these three separate tranches that you have from the beginning of the year to February 19th, from February 19th to March 13th, and then March 13th to March 25th. It's all stuff that I would kind of expect. And again, we're not even out of the first quarter yet, right? So all of this data is
lots of excitement.
Extremely short term over one quarter. But again, I don't want to beat a dead horse, but we have talked about quite significantly this year that Q1 of a post-election year tends to be pretty volatile and pretty weak when it comes to stock performance. So, I don't think we should be surprised about this, even though it might not feel the greatest. We kind of knew it going into this that there might be some volatility. So I think a lot of people are going to welcome Q2 and hopefully have a new start and hopefully the volatility dies down a little bit, which it already has over the past week or so, which I think is a good start.
In this last period from the 13th to the 25th, I believe the VIX fell from the 20s down to 17 or something like that.
Yeah.
I don't have the data in front of me, but volatility dropped off notably. My last piece here is really just kind of an interesting breakdown on U.S. households. I picked up this from a Bloomberg article yesterday, actually, and the data all comes from the Federal Reserve. The article is titled "Half of American Households Hold 97.5% of the National Wealth," which I don't think is very shocking for most listeners. But there are some interesting charts, particularly the second one in here, that kind of caught my eye and might explain why that divergence happens. Just generally speaking, throughout history, it's not just the U.S. This has happened for hundreds of years. So the first chart here shows the household wealth by 5% percentile groups. Bottom 50, next 40, next 9, remaining 1%, and then the top 0.1%. And you can see the share, or basically the percentage on a pie chart of 100 that each one of those groups makes up. I'm going to read just a few lines from the article as we go through this. The lower 50% of the distribution saw their wealth share improve marginally during President Joe Biden's term in office, climbing from 2.2% to about 2.5%. So they went from about $4 trillion to $5.25 trillion. Whereas the top 0.1%, so the very tip top, gained more than $6 trillion in net wealth, mainly thanks to a surge in the value of corporate equities and mutual fund shares. And this next chart that we're going to show, this is the part that really kind of caught my eye. I thought people might find it interesting. When you think about that, top 1%, so much of it does come down to corporate equities and mutual fund shares that have been passed down through generations somehow, essentially, and they make up a very large percentage of the net worth and the wealth of that top 1%. And corporate equities and mutual funds, that's the market, right? That's what we're talking about. So just a cool chart just to kind of show listeners what the average kind of looks like.
Yeah, and I think, the biggest thing that, people might take away from looking at this chart is that, you look at the bottom 50% of the population, most of, maybe not most of, but half of their wealth is in their home, right? Mm-hmm. It's in real estate, So I think that's why, things may have been so challenging for that group of the population over the past several years with inflation raging and interest rates raging, specifically interest rates on homes. That makes it hard when most of your wealth is tied up in your home. But then, looking at the rosy side of that, I think, the equity that people have in their homes right now is at an all-time high. So, if people needed to access that cash, they could. But it's nonetheless, it's a very interesting chart. I don't think any of this is surprising. You look at the top 0.1%, most of their wealth is in corporate equities and mutual fund shares. Next biggest part is private businesses.
Not surprising at all.
And you go lower and lower down the tier towards the bottom, and defined contribution pension plans becomes a larger chunk, and private business ownership shrinks. Yeah. So yeah, it's just nice to see this on a chart.
Yeah, I've never seen one kind of broken out exactly this way. So the last little piece of the article is kind of discussing how this chart has evolved relative to wealth by age. So overall, the wealth gains at the top end of the distribution during the period were accompanied by a decrease in debt levels, with the top 1% of households managing to pay down their net mortgage debt. Meanwhile, families lower down the scale added debt along with assets, including some $8 billion in high-interest consumer credit amassed over the 4-year period. Again, this is the 4-year Biden period. Broken down by age cohorts, the period saw U.S. wealth increasingly accrue to older households. The gains are partly a function of demographics, as large baby boomer generation age into their 70s. People born before 1965 also own more than half of the U.S. real estate wealth. So, and we've talked about this a lot, the aging demographics, the baby boomers, and the concentration of wealth from a statistical point of view, again, is just kind of rolling down the age channel, so to speak. Not surprising, but interesting.
Yeah, very much so. That was a good piece. So if you want to check out that full Bloomberg article, like I said earlier, the links to those will be in our show notes. Lastly, financial planning topic of the week was a article from Christine Benz at Morningstar on March 16th titled, "Should You Pay Off Your Mortgage Early or Invest?" So kind of a nice segue into what we were just talking about. And, this isn't the first time we've discussed or had the debate over whether you should pay off your mortgage early or if you should be investing the extra funds that you have. And at the end of the day, it really comes down to each individual's psyche, in my opinion. And what I mean by that is, even if you crunch the numbers and it makes financial sense for you to invest money rather than pay down your mortgage debt, there's going to be some people out there that will be bothered by that and be bothered by, not paying off their mortgage as quick as possible. And that's okay, right? I think you need to take into account your personal views and your preferences on situations like this, as long as it isn't adversely affecting your long-term financial goals. But, I think the viewpoint on what we do is everything has to be optimized from a numbers standpoint to do the best thing that the data says and that the financial plan says. And like I said earlier, the only thing it doesn't take into account is your psyche. And if you're someone that has high anxiety when you have growing debt or a large portion of your assets assets relative to debt is not where you want it to be, I think that's important to take that stuff into consideration. So Christine says, let's see, she had a meeting with her financial advisor, and he asked her and her husband the question, remind me why you still have a mortgage. Our financial planner posed that question to my husband and me about a decade ago. He pointed out that we weren't getting much of a tax benefit from carrying the debt because such a big percentage of our payments were going toward the principal at the tail end of our 15-year loan. He could also see that we had the cash. It was sitting in our Vanguard municipal money market fund, earning much less than our 2.875% mortgage rate. In other words, a mortgage paydown promised a higher return on our money than it was earning in our investment accounts. We had been hanging on to the mortgage because a mortgage rate of less than 3% seemed like a great deal, and it certainly was relative to our very first mortgage of 8.75% in 1994. But the numbers in our household balance sheet argued otherwise. You should ask yourself the following questions to get the answer you want. Do you need the liquidity? If you do, that argues against steering a big share of your available funds toward paying down a mortgage. You can tap home equity via a home equity line of credit if you need to, but it's obviously a much simpler thing to dip into a brokerage account if you have a cash need. And that's one of the things that we talk about a lot, Nick. It's liquidity. And, my simple definition of that is how quickly you can turn an investment into grocery money, right? So a stock, you can sell it, have the money later that day or the next day, right?
Yeah. Pinning on your bank and settlement and things of that nature.
Right. Your house.
As a trader, I should say that.
Yeah. And, a house, not very liquid, right? It takes time to get it ready to be listed, take the pictures, put it online, get a realtor, have people come look at the house, go to closing, and you're at a couple of months at that point, right?
It also depends on the size of your house and the market.
Exactly. And that's, not only when we're talking about, investing in the stock market or investing in real estate, but also like private investment funds, right? A lot of the times they will have quarterly or semi-annual liquidity, meaning you can only get your money out twice per year or once a quarter.
And it's still not guaranteed.
Yeah. They have the right to restrict liquidity to a certain percentage of the fund. Right. So, if there was a situation where there was a liquidity crunch, like back during the great financial crisis, and 80% of the people came to them and said, I want to get my money out, most of the time it's not going to happen. They'll restrict that, right?
In that time period, probably 5% got their
money.
And
that's something that, and again, it's not to talk poorly or have a negative view about alternative investment funds. You just have to know the rules and regulations going into it, because if you don't and you're just attracted to, it's a 9% annualized return with extremely low volatility, it's like a no-brainer. Usually there's things that come along with that, and one of those things are you can't just take your money out whenever you want, and that's a reason why I just encourage people to look deep into that to see what the restrictions are, because if you think you can take your money out and you can't, it's going to be a pretty rude awakening when you get to that point.
And another piece of it on the private credit side of things is obviously those funds or investments, they could underperform for an extended period of time. And if they're illiquid and you're unhappy with the performance, sometimes there's not much you can do about it.
Yeah.
So, when you see the private credit funds, like you said, annualized 9%. So, well, maybe. It's not guaranteed.
Right.
Nothing's guaranteed.
Right.
So that's where the illiquidity can really rub people the wrong way.
Yeah, for sure. Second question is, how do the returns compare? The core return from debt paydown is pretty straightforward, whatever your mortgage interest rate is. Deciding on what type of return to assume for your investments is tougher, because the return you earn from a mortgage paydown is guaranteed. The most conservative investment comparison is with an investment type that's similarly guaranteed. That's the benchmark that my husband and I used when we decided to pay off our mortgage. We had cash in our account that was earning an interest rate substantially lower than the rate on the debt we were servicing. With today's higher yields on cash and bonds, however, mortgage paydown might not add up for people with older loans. Next question is, what is your life stage? Life stage and time horizon can affect the attractiveness of debt paydown versus investing. More risk-tolerant types, specifically younger people with very long time horizons until retirement, might avoid mortgage prepayment in favor of stock investing. While stock returns are not guaranteed, history suggests that over several decade periods, they'll likely be higher than even today's higher mortgage rates. But if you're close to retirement, that means your time horizon until you'll need to be tapping your portfolio has shortened. It also likely means that your investment mix has gotten more conservative and your expected portfolio return has declined. In that instance, your investments might not necessarily out-earn your mortgage rate. What are the tax implications? So she just points out that the tax advantages of carrying mortgage debt are much less than they were several years ago, and that changed in 2018 with the standard deduction increasing significantly and people not itemizing anymore. So it's important to look at that. Next, what your carrying costs are. A big one is private mortgage insurance, which typically is required for borrowers who have less than 20% equity in their homes. So that might influence your decision of, putting down at least 20% so you're not paying PMI. And last but not least, what I talked about earlier, do you need peace of mind? She says if the math around whether to prepay your mortgage is kind of squishy, for example, your mortgage rate and your expected portfolio return are about 5%, peace of mind considerations are a good tiebreaker. What brings peace of mind varies with each individual, which we talked about earlier. So thought it was a good read. Check out the full article if you want to see the entire thing. But yeah, I think it's always going to be a big debate. And to me, if you were a robot, it's a pretty easy calculation. You just compare the benefits and cons of investing and benefits and cons of prepaying the mortgage. You weigh those against each other, and you make the decision from a numbers standpoint. But whether you like it or not, you are going to have some emotional feeling that's stronger one way or the other.
And don't forget when you're doing your analytics and your home budget to account for compounding on your investing, because that is a huge component of it.
Precisely.
Yeah.
Precisely. Well, that's everything I had. Nick, do you have anything to add before we leave it there for the week?
No, it's a great article there at the end. I really like that. So,
well, thanks everyone for tuning in and listening to episode 293 of the Independent Advisors podcast. We will be back with you next week for episode 294.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.